Mariano is a forensic accountant. I'll get him to tell you what that means. And he's going to talk to us about the more business side of things. We've already had some questions this morning about making your first hire, and that's something that you're going to talk about, but I think in your second session, maybe.
That's right, that's the second session.
Yep.
This is,
we can barely hear you.
Oh, sorry, can you hear me now?
Yep.
It's about using accountants in family law matters for disputes.
Oh, we can't hear you again, I'm sorry.
Just while Mariano's getting set up, Mariano is from Vincents and forensic accountant, and we'll be sharing this morning and this afternoon. Again, if you've got any questions, please feel free to add them to the chat. Can you hear it?
Yeah, can you hear me now?
Yeah, that's better.
Okay, sorry, I'll just keep the mouthpiece near my mouth. Okay, let me try to share my screen. Which one is it? I think it's this one.
Yep.
Yep. Can you see the presentation?
Excellent. Thank you.
Excellent. Okay, great. Okay. So I sort of titled it financial statements, even though this is more about when and where you want to probably use accountants, but it's probably around this area. And about financial statements, and I sort of put a little subheading, truth or fiction. One of my most hated professions are accountants, and often because the ones I come across are not too good at times, and they don't provide clients very good information in many situations, especially when you're trying to get down to the truth. So you sort of got to, and that's not true about all accountants. That's just a side swipe at my own profession, but it's more about the fact of you've got to look at the information that you are being given and sort of make heads and tails about it yourself. Janice has got my slides, and she will be providing that to you as we go along. Sorry, after this session, so you'll have that. So as part of it, there's the typical disclaimer at the beginning of it. It's general, so lawyers will understand that. Bit about myself. I'm a fellow of the Institute of Chartered Accountants. I'm also a forensic accounting specialist, registered tax agent, been practicing for over 30 years, doing forensics for about 32, 33 years across a variety of areas. Now, accounting, what is it, right? This is the first section I just want to do is a bit of an overview, and it's really about this definition, which you can read on the screen, right? And probably the interesting word is the art. Often, there's an old joke about an accountant being in a room and sort of being asked the question, what's 1 + 1 equal? And, they go up, one accountant says in an interview, 2, another one says, 3, and another one says, what do you want it to equal? And that's really probably that last point is the art. You can often change accounts in a way to reflect a certain value or a certain result, whether that's on purpose or whether that's to come up with a particular desired outcome for accounting reasons or for tax reasons or whatever the case might be. So there is an element, whether you want to call it art or whether you want to call it just knowing how to prepare accounts, but it's all about this recording, classifying, and understanding what the information means. So when you're looking at and trying to read financial statements, I think things you need to understand is who's prepared them. Has it been an external accountant? Has it been the internal bookkeeper? Has it been the client themselves? The one good thing since GST being introduced many years ago is that it's forced a lot of people in businesses to start using computerized software. So it means that they start recording their information, their transactions on a regular basis. And so, but it also depends on how they process those transactions, right? Where do they place the expense or the payment? Where do they classify it as? So you've got to ask, as I said, who's done it? So, and that can tell you whether or not you can place trust in the information that it's been provided. what purposes were they prepared? And that sort of links with this thing over here, number 4, which is the entity itself, assuming we're talking about like a company or a trust or something like that. You can have what's called a reporting entity, which is bound by ASIC rules and accounting standards. And then, and that's not the majority of entities. That's in fact the majority of entities are what we would refer to as non-reporting entities. Oh, sorry, can you see my mouse on screen, Janice? Okay, sorry, I had it on the wrong screen. So 2 and 4 are a bit related. Now, reporting entities basically almost mean that the entity has to be audited, whereas a non-reporting entity, which is the majority of entities, okay, and in this case, businesses, when I'm talking about not just entity, but also business, are non-reporting. So they don't have to follow accounting standards, okay? So for what purpose are they prepared? Because some people prepare financial statements for financing reasons, some for tax reasons, for valuation reasons, and it's amazing what you find over time. So you've got to ask yourself that question as well. Then the other thing is, do the financial statements that you're looking at, do they represent the performance of the entity? So for example, is it a company or is it just the business, right? Because you could have a company might own 3 different businesses. So are you looking at the financial result of a particular business? I had a case a few years ago where a fellow sold their cafe, but they sold 1 cafe out of 3. So the question was, when they provided a profit and loss statement for the business being sold, but were those transactions related to that specific business, or did some of those transactions relate to the other business? So you've got to take that into account as well. I think this is really important, which sort of goes to this little graph I've got on the next page. Understanding the group structure, especially where you have more than one entity, right? How many entities are there in the structure? I mean, the amount of times I have clients that say, oh, I'm running a partnership when it's a company, or I've got a company when it's a partnership, or a sole trader, or a trust, or there are super funds involved, or they've got more than one entity involved. So how many, are there, right? How is it structured? How is it set up? What's the relationship between the entities? So, when you sort of look at this little graph, you might have the, let's say, tax reasons nowadays, this is not as common, but many years ago, you might have, let's say up in this box here, you might have a company running your legal practice. Then you might have a service trust underneath it. You could have a super fund over here owning the premises, which then leases to the service entity, then which marks that up to the legal practice. So what you're trying to do is get profits away from up here in the event that you might get sued, and you start filtering it down to a service entity where you can flick those profits to family members or off to the super fund and keep it within yourself, okay? So you've got to understand what the relationships are. This structure is really, number one, it's almost like if you're talking to your client, don't trust your client, okay? And I don't mean but trusting your client, not trusting your client as in I just don't completely trust them at all. It's make the assumption that they don't necessarily always understand what structures they have or what entities they have, okay? One of the things you'd always want to do is inevitably do a company search, personal search on the client to know what entities are related to them, if they have any, ABN lookups, those sorts of things. If not, speak to their accountant, right? And hopefully they'll be able to put you into the picture, all right? But you've got to understand the structure so that when you come to asking a question for yourself, what is the value of a business, or what am I trying to look for, or what am I trying to achieve? Even putting the little flow chart down on a piece of paper, can often assist. I mean, I've got one family law investigation at the moment where there must be literally 15 different entities. Having a flow chart that when you have that sort of situation and understand the interrelationship between them is essential, because you could have one entity, you've got this sort of flow structure, but you might have a situation where this entity here then charges this entity directly, not necessarily between an interposed entity. So you've got to understand because this comes to the issue about where money is flowing, how it's flowing between them, how it's being accounted for.
Yep. And what I see a lot of too, Mariano, is SMSFs making that flow chart even more difficult to understand. And the clients don't understand where that super and other assets are fundamentally different. So again, the advice you're getting from the instructions you get from clients are useless on that point.
Yeah, and you've got a situation where with super funds, people see super funds as that's their money. Well, in a sense, yeah, yes, it is, but at the same time, no, it's not, because whilst the super fund's going and it's not in, basically retirement phase or pension phase, okay, there's an interposed trust. They are, legally, it is not their asset. Okay, strictly speaking. Now, from a family law perspective, obviously we lift all those corporate veils and we get down to the bottom truth about what's really going on, but they don't understand the structures. And look, there is a lot of people who rely upon their accountants to give them advice without asking questions. Okay, and I think look, my practice has always been try to give clients as much information as possible and make them understand, right? So that they know what's going on, all right? That's not always the case. They simply say, I leave everything to my accountant, all right? Unfortunately, I think that's a dangerous practice. Mm-hmm. When it comes to preparing, when you look at the output, what people get are financial statements or annual reports, you got to look at it and say, well, accounting is a double entry bookkeeping system. For every debit, there's a credit. I'm doing a family law investigation where, I'm looking at loan accounts on the balance sheets of a particular company. And so, but in order to understand how that loan account arose, I have to go back to the basics of double book entry accounting and say, okay, well, this is a credit. Where's the debit? How was that debit treated? Because that might be important as to whether or not the loan account really exists, right? And, I had one current case where it's all about one entity sold, let's say this is entity A and this was entity B. Entity A sold the business to entity B for a particular value. Well, did it sell it at market value, or was it done at a discounted value because entity B was actually owned by my clients, the wife? It was owned by her husband and his brother, right? Yet in entity A, it was only owned by him. So what it was is that, and this is pre-separation, but when there were problems, and the question was, well, did this transaction occur to try to shift asset value, shift control, shift etc.? So did the brother actually pay market value for the business? Did those funds transfer? Did it not transfer? So we've got to get back to the entry, the actual physical entries, because that tells us what they say was going on. How people classify things. Generally accounting principles, right? If you want to sleep well at night, just pull up an accounting standard, read that, and you will sleep. Trust me. But again, depending upon, this goes back to this here: reporting entity, non-reporting entity. Accounting principles don't have to be followed if you're a non-reporting entity. Okay, and so basically, it's almost to the extent where a business or the owners or the accountant can make up their own accounting. All right. So you just need to be aware, have accounting standards been applied, or which part of the accounting standards have been applied? But you need to understand this aspect of it when reading financial statements. When financial statements are generally broken down, and this is typical of a reported entity, because this last one here doesn't necessarily exist, but most financial statements for an entity you'll see, and typically this might be, can apply to partnerships, can apply to sometimes sole traders, but typically you'll see this for trusts, companies, super funds, etc. Comprehensive income or profit and loss statement. This is the income, the expenses of the business. Balance sheet, this is the assets, the liability. Cash flows, as I say, this is more about representing how cash has come in and come out of the business. And notes. Now, notes can be important because this is often where information is provided as to the accounting standard or gives a bit more detail. Now, depending upon the size of the entity, you may have all four, you might only see the first two. you might only ever see the first one. So for example, if you're a sole trader, you're only going to ever see the first one, typically. What are financial statements? Well, in terms of profit and loss, there's your revenue, there's your expenses, and then there's your, what leaves left over is your profit or your loss. I just noticing the time, I need to sort of get through this. And then of course, if anybody on this is looking at this, got any questions, I'm happy for you to contact me and go through this in more detail with you, all right? A balance sheet, it's your assets, whatever the assets of the business are, less the liabilities gives you the net assets, okay? And that the net assets and the equity equal, okay? If I were to put a box around this, whoops, what happened there? A box around this one equals this one, this less this equals this, okay? So again, and then what's in here? Within an asset, you can have both assets and liabilities. You can have what we call current assets, current liabilities, non-current assets, non-current liabilities. Current basically means anything that's likely to happen in the next 12 months. Non-current is 12 months or more. I'll keep going because we're running a bit out of time. The title of this was legal manipulation. Really, this will look at two things. This can be either legal manipulation and or, you know, non-legal manipulation, right? Why do people manipulate accounts? Well, they might try to be getting more finance, right? From a finance perspective, if you've got a better profitability or you've got a better net asset value, you can get more finance, all right? If anybody goes for a home loan, guess what? If you can show you've got more income or more assets, you'll get a bigger loan, all right? So you can see the reason for potential manipulation. Income tax, well, a lot of businesses a lot of people in business want to manipulate or drop their profitability as much as possible for, guess what? They pay less tax. These two counter each other. You know, if you have less income tax, you have less profit, therefore you get less finance, right? I'm just doing a case at the moment where a person has been running a logging business. It's not a family law matter. It's a personal injury matter. He's been running it for 18 years. He turned over $1.8 million in that period and lost almost $100,000. You know, every year he was been losing money. Why would you run a business for such a long period of time? Why? Because I suspect it's in here. He's not declaring all his income, or he's pumping through a lot of expenses which aren't business related. That's manipulation. Not all manipulation is always necessarily done on purpose, and I'll get to that in a moment. Again, reporting to investors, you know, if you've got investors, you know, increasing profitability or increasing your asset value, the results of the business will get better. That might go with, you know, if you're in management, if you make this look better, your remuneration might go up, okay? I had a fellow a few years ago who kept pushing the debtors in the business back from over 90 days to under 90 days. He was manipulating the accounts. That made him looking like he was collecting his debtors less than 90 days. He would get bonuses if he kept it under 90 days. So his remuneration was linked to the results. If you've got losses or you've got some sort of litigation, you know, you might be able to increase your losses. Everybody understands from a property settlement perspective, if you can make the, you know, from a the spouse who doesn't own the business wants the value of the business to be as high as possible. The spouse who owns the business wants it to be as low as possible. So manipulating asset values, profitability, etc., can either help or detract from the value at the end of the day. Valuation purposes, again, you know, if you can get certain assets down, you might not pay as much stamp duty, or you might not pay as much income tax if you're selling an asset. Again, management, pressure, reward. There are reasons why we see for manipulation. Examples of manipulation within accounts that we see. Leases, you know, is the asset, you know, if you lease an asset, right? Let's say you lease a motor vehicle, just for the simple, or let's say a truck. You know, I own a trucking business. I go out and lease a $250,000 Kenworth. Okay, well, strictly speaking, under a lease as compared to a hire purchase, a lease, I don't own the asset until the lease payments are finished. Now, years ago, leases, you only saw the lease payment as an expense. You didn't see the asset on the books. Nowadays, under proper accounting standards, you record the asset and you record the finance. You almost treat it as if it's a loan. But if you're not following accounting standards and it's under lease, that asset you will not see. So let's just say you've got the $250,000 Kentworth that's been leased over a 5-year period. You got 6 months to go. That thing could still be worth a couple of $100,000, yet on the balance sheet of the books, it's not going to be there, right? Because it's a lease, and it's only the lease expense is being shown in the profit and loss statement. So the question, is it being recorded? All right. But again, depending on how the accounting is done, is it there? Is it not there? That's one area where it can be not necessarily manipulated for the purposes of trying to hide anything, but it could be done for that reason, but it might not be done for that reason. It's just simple accounting rather than extra time for the accountant to record the asset, pick up the liability, pick up the interest costs, etc. It's just a pain in the backside from an accounting perspective. All right. Much easier just to record the expense. Depreciation. This is a great area, especially in the last few years. Many of you may be aware that the government has introduced changes from a tax perspective to be able to write off assets. So let's say, you were using a car for 100% for business reasons, and I'll just assume that. You can go out and buy yourself a brand new car for $30,000 and claim it as a tax deduction, all right? So you claim the cost as an expense, which reduces your profit. You don't have anything on the balance sheet as an asset because you've effectively written it off, right? And as a result, your profits of the business are decreased. Yet the reality is you actually have an asset there. So these simplified write-off rules actually go to reduce profits, reduce income, and not disclose assets. So you got to be aware of what might be going through. Now, sometimes these are put through the accounts, sometimes they're not. Sometimes they're put through the tax return. Accounting standards, interpretation of those. I want to move through this because I just noticed the time. Cash versus accruals. Are you declaring your income on a cash basis or a receipts basis? If you guys are a sole trader, then you could declare your income when you receive it, not when you invoice it, like a barrister. But if you set up a company, you're going to have to declare the income when you invoice it, not when you receive it, even though it might be months down the track. So there's a timing difference of income, all right? Do you capitalize an expense? Do you capitalize a cost, or do you expense it? This depreciation with these asset write-off rules and this sort of go hand in hand. How do you value the asset? Do you increase it? Do you decrease it, right? What sort of depreciation do you apply? Accounting for stock and WIP, all right? This is a great area for accountants to manipulate the profit of a business. If I want to reduce the profit of the business, I lower my stock value, right? My closing stock on hand, which also then lowers my asset value. If I want to show a bigger profit, I show a greater stock, all right? But then it also increases your stock. As I said, I could talk on this for 3 hours, you know what I mean? So I don't want to get through to too much of the mechanics, but this is one area where accountants can easily manipulate income and asset values of a business, right, is through stock. Sources of information, I'll leave you this to look at later, but there's a whole heap of areas of sources of information which you might want to look at to get information about a business, okay? I'm running out of time, so I've got to move on. Question you might want to ask yourself, and that was sort of where the topic was going from originally, can I solve the puzzle myself, right? Well, yeah, you can. You can solve the puzzle, but you've just got to know where all the pieces are, right? What do all the pieces mean, okay? Are you able to read and understand those financial statements? Who put them together and how are they constructed? As long as you understand all of that, yeah, you can go right ahead and do it yourself, no problems whatsoever, right? And this is not about trying to direct work to a forensic accountant or somebody else. It's about saying you've got to make sure, and I'll deal with this in my next session, about your professional indemnity insurance, okay? You don't want to get sued because you haven't done something, right? Or you haven't brought in the right professional to assist you at the end of the day.
And
right?
also, you don't want the client coming back to you to keep saying, but you forgot this, but you forgot that.
Oh,
If you're
absolutely.
not going to get sued, you're going to spend so much time that you cannot bill trying to get them up to speed.
That's right. And do you want to waste your time spending time on something that you will spend longer and not recovering your time? And that goes back to the previous one, right at the question at the end about from Fiona, was these new practices. Well, if you go fixed fee approach, which a lot of practitioners are going nowadays, you're going to get less money dollar per hour if you spend more time. Okay. Do I need to do it? Do you need to do it yourself? No. But one of the things is you might have a situation where your client can't afford a valuation, right, or a full investigation. One of the things I've done with clients in the past is say, well, look, try to work out your top 10 lists of things that you want looked at or investigated. All right. What are they? List them in priority and then say, okay, look, I can't afford $2,000. What can you do for $2,000? Right. So it's about saying, don't go for everything. I mean, I kid you not, in this recent case I had, there was the boardroom table is probably 20 foot long, right, in this law firm. She had all this butcher paper. By the time she unfolded it, right, took up half the table, right, and had notes and comments everywhere. And I sort of looked at it and I said, stop. You are going to waste your time and money if I even attempt to look at that, because I'm trying to find a needle in a haystack. Narrow your investigation to where are you going to get biggest bang for buck? That's the issue that you really need to try to go to. All right. And then you've got to keep coming back to, do you have that expertise to solve the puzzle? If not, think about where you go. All right. But you might be able to solve the puzzle without spending a lot of money. Okay. Especially in a collaborative sense. All right. Financial statements, just a couple of points to think about. Okay. Financial statements are often prepared at cost. Okay. So the real asset value is necessary. Property is a great example. I bought the property 10 years ago for $1 million. That's probably worth double now. Okay. Things like that. Okay. Are asset values truly reflected? Is goodwill recorded? Is it not recorded? Are all the debts recorded? Especially when you're not reporting properly. COVID, as an example, a lot of businesses have got rent relief. It's not rent relief forever and a day. You still owe us the money. We're just not getting you to pay for the last 6 months. So you could have a 6-month liability that's not on the books of the business. All right, as an example to think about. You know what I mean? So are all debts are not recorded. In valuing business. Valuing businesses, there's lots of different ways. It's, when I first spoke to Janice about this, it was, just don't go to the bottom bit on the balance sheet, right? There's a future maintainable earning approach, or a DCF method, a net asset method. Net assets is sort of just going to the bottom of the balance sheet. But again, as long as all the values are properly recorded. Okay. I suppose the question comes down to is, and when you're looking at an entity, you got to look at a combination, not only the business, but are there surplus assets as well. So if you're valuing the business and valuing the entity, it's not the business is not on top of the net asset value. It could be inside itself. Okay. What is value? Value is not about the past; it's about the future, right? Necessarily. What is the value today? But when you're looking at a business and an entity, it's about also considering the future values. Okay. Past performance of a business is only a reference point, and a best example is at a coffee shop. 2 coffee shops, one in CBD Sydney, one in a suburb. All right, I live in Maroubra. One of my coffee shops that I go to, okay, since COVID, sales through the roof. Okay, why? Everybody's at home. If COVID stops, what's going to happen to their sales? It'll go down. More people go back to the city. You got to consider what's going on around you at the same time. Have all assets been identified and considered? As I said, I know I'm run out of time now, because I think your next session's supposed to start, isn't it, Janice?
We're on a break now, so.
Oh, okay. So look, I'll just take 2 seconds. Mm-hmm. Division 7A, which is a big thing, it's about loans. People pull money out of entities quite often. which are really in reality loans, okay? Sorry, pull money out and are treated as a loan, but it could be another way of what should have otherwise been classified as profits. The reason why, if it's therefore profits, it can be considered a Div 7A, which is the acronym. The Div 7A means that person could really be taking out income, being dividends, and therefore they have a tax liability that I don't know about, okay? So depending on who you're acting for, you've got to be aware that they might be doing this. People don't understand what, they pull money out of say a company, and they think it's their money. It's not their money, it's the company's money, all right? And I just want to deal with this one very quickly. What's taxable income? Because it goes to that case that you referred me to, Janice's Barnwell or Kedrick, okay? Taxable income. Taxable income is assessable income less allowable deductions, okay? Tax is statute, okay? You as lawyers can advise clients on tax. You're allowed to do that because you're a lawyer, all right? But are you, got the expertise, all right? And so this Barnwell was, they looked at the taxable income. Well, there was a capital gain, but it was from a sale of an asset. And this, the issue was around here was working out what the income of the spouse of the wife was for the purposes of maintenance. Okay, but the problem was if a taxable income included a capital gain, which is a one-off transaction, that's not her normal income year in, year out. Okay, there was also an element that part of her income was caught up in the capitalization value of the business. So there was potentially a double dipping issue between her income and the value of the business from an asset perspective. So you need to take this into account. And this comes back to reading financial statements, reading tax returns. Do you understand them? Another example, if you were wanting to take into a capital gain on the tax return, if I've held that asset for more than 12 months, I only pay tax on half the value of the gain, not the full value of the gain. Okay, so if you wanted to know what the gain was, the gain's not necessarily what's in the tax return, but it could be double that value. Okay, gross business income. I've talked about receipts and accrual previously, but again, all these elements affect assessable income. When are you receiving it? Are you a sole trader versus a company versus a trust? Okay, these are things you need to be in consideration of. Sorry, it's a big topic to try to cram into half an hour. So, has anyone got any questions?
Just a question generally on setting up the finances for the business, etc. As well, and maybe you'll cover this on the next topic this afternoon. But should we be like in our own business, not just our family law clients, but what should we be looking at each month? Our own sort of P&L. Like I myself look at profit and loss statements and the balance sheet and look at that, the actuals compared to the balance sheet. I have a bookkeeper that I meet with. Like, what are the steps that we should be doing just to make sure that we're on top of our own firm's finances?
Look, yeah, I'll sort of cover that. I mean, and one of the slides I've got is, basically, it's not exactly these words, but cash is king. Okay. And I had one client the other day. He said, look, the way I understand my business is I look at the bank account. Okay. Now that's an oversimplification. Okay. Because it really comes down to the nature of the business the nature of the business really. Okay. So it sort of, you got to understand that at the same time of what is it you've got to look at. So for example, as a lawyer, okay, if you're a sole trader, then if I've got cash coming in on a regular basis, then I know I'm going okay. All right. If I'm invoicing and the cash ain't coming in, means I've got no money coming in. I'm not going to be able to pay my bills. Right. If you've got lots of employees, are employees taking their holidays, or are they accruing liabilities that you're going to be stuck with down the track that you don't aware of? After a few years, you might have an employee that's got 12 weeks holiday, and all of a sudden they say to you, hey, I'm going to go on holidays for the next 3 months, and you're going to go, whoa. Now, put aside the employment perspective as to whether or not they can or they can't, you've all of a sudden got a 12-week liability, right? But no revenue coming in from them doing anything. Okay. So it's really hard to identify exactly, because it really comes down to the nature of the business. Now, personal injury firm is going to be very different to a family law practice, to a commercial practice that's billing their clients on a regular basis. So, cash, debtors, keeping on top of your expenses, not using the tax man as a loan, which I'll sort of deal with in the next session. It's very easy to not pay the tax man last. It's very easy to pay the tax man last. Okay, and that's often where people being also come undone as well. Sorry, that's a really big question. Right.
Yeah, I appreciate that. So thank you so much. We've been working with, I've known Mariano for quite a few years now, through Kirkman Family Law and now through Family Property, and he's provided some input on the questions to ask with around businesses, etc., and tax and the information we need, and provided that input into Family Property. So he does some great work, and we look forward to hearing from you this afternoon. But